Welcome to the Deep Dive. This is TalkTickers, your essential guide to really getting inside the latest earnings calls.
Glad to be here.
Today, we're doing a deep dive into Greenbrier Companies' third quarter for 2025. We'll unpack their results, what management's saying about the outlook, the market.
And what it all might mean.
Exactly. Greenbrier had a really strong quarter. Seems like solid strategic execution. So let's jump right into those numbers.
Absolutely. Q3 2025, it wasn't just good. It was a standout quarter for them, really flexing their financial muscles, you could say.
Okay, so what are we seeing?
Net earnings hit $60.1 million. That's 1.86 per share. Shows impressive growth, both sequentially and year over year.
Okay.
But what really stands out to me, actually, is their aggregate gross margin. It soared to 18%.
18%, wow.
Yeah, and this isn't just a one-off. It's their seventh consecutive quarter hitting or beating their mid-teens long-term target.
7 quarters in a row. That suggests what really ingrained operational discipline, maybe smart investments paying off.
It's exactly. Could be automation, supply chain work, key stuff in a sector like railcar manufacturing, which can be pretty volatile, as you know.
Yeah, that 18% definitely jumped out at me too. And it's not just the margins, right?
No, definitely not.
Their return on invested capital, ROIC.
12.9%.
Right.
Which puts them comfortably inside their 2026 target range. That's 10% to 14%.
Right. So hitting those kinds of efficiency metrics consistently tells you they're not just, chasing revenue.
They're doing it profitably, efficiently.
Yeah.
Turning assets into earnings well within, even beating their own benchmarks.
Okay. And top line, revenue.
Revenue for the quarter was $843 million. That's an 11% improvement sequentially. Keeps them firmly on track for their full year guidance.
Yep side.
And operating income also came in strong, $93 million, which is about 11% of revenue.
Okay, strong performance across the board then.
And look at their balance sheet. Liquidity is the highest it's been since 2023, nearly $770 million, with a healthy $300 million of that in cash.
That's not just a buffer, that's dry powder, right?
Exactly.
Yeah.
It suggests Greenbrier is well positioned, maybe for opportunistic acquisitions. This market can be fragmented. Or maybe just flexibility to ramp up CapEx quickly if things pick up.
Gives them an edge over rivals with less cash, maybe.
For sure. Helps them navigate different market conditions.
So beyond these strong headline numbers, what's really driving it seems like a lot boils down to internal efficiency.
Yeah, definitely.
Let's unpack that. Their operational excellence stuff,
Yeah.
particularly Europe and North America.
Right. So Europe. The last freight wagon actually rolled out of their Arad, Romania facility ahead of schedule. That was late May.
Ahead of schedule. Nice.
Yeah. Once that whole capacity rationalization is done, they expect annual savings of at least $10 million.
Wow. That's a clear win. Disciplined footprint stuff.
Definitely. And then in North America, they're expanding their insourcing capacity down in Mexico. That's nearing completion. They expect the full value from that to come through fiscal 2026 and beyond. So yeah, it's like this strategic chess game, optimizing their global network.
Yeah.
Clearly paying off, improving their cost structure.
And this efficiency focus, it's not just about cutting costs. It feeds into strengthening their financial foundation too, which brings us to their balance sheet strategy. That seemed pretty noteworthy.
Yeah, they did some important work there.
Renewing and extending those 2 bank facilities, $850 million total, pushing maturities out to 2030.
Right, that was back in May.
So no significant maturities until 2027. That feels like a real power move in terms of planning. What does that kind of long-term stability really do for them?
Well, part of it, and this really stands out to me, is their strategic shift. They're using more non-recourse borrowing to support the lease fleet growth.
Non-recourse. Okay, break that down. But why is that important for listeners to understand?
Well, it basically means the debt is secured by specific assets, in this case, the leased rail cars, and doesn't have a claim on Greenbrier's other corporate assets if something goes wrong with those specific leases. So for you listening, it tells you how they're funding growth without weighing down the main corporate balance sheet quite as much. It's pretty sophisticated financial engineering.
Okay, got it. Isolating risk.
Exactly. And they also generated nearly $140 million in operating cash flow this quarter, mostly from that strong operating performance and good working capital management. Just solidifies their footing even more.
And they're putting that strength to work not just in the business, but also returning capital to shareholders.
Right. Consistent theme for them.
They declared a 32-cent per share dividend. That's their 45th consecutive quarterly dividend.
45th. That's a remarkable streak.
It really is. Signals a very consistent, reliable commitment. That can be a huge draw for, long-term investors.
Absolutely. Plus, they bought back shares, too. About $22 million worth during the quarter.
And they still have room in the authorization.
Yep. $78 million remaining in the current plan.
So dividends and buybacks, it shows confidence from the board, right? Balancing investment for the future with direct returns now.
That's exactly how I read it. Confidence in the long-term strategy.
Okay, let's pivot a bit. Leasing and fleet management, that's a big part of their recurring revenue push.
Huge part.
Recurring revenue hit almost $165 million over the last 4 quarters. That's nearly 50% growth from where they started 2 years ago.
Yeah, they're almost halfway to their goal already. They want to double recurring revenues by fiscal 2028.
And fleet utilization, still high.
Impressively high, 98%.
Wow.
Now, their plan is to invest up to $300 million annually on a net basis into the lease fleet. But net investments are likely going to be lower this year. Seems due to shifts in customer activity, maybe product mix.
So they're flexible, not just buying cars for the sake of it.
Seems like it. Highlights a disciplined approach, making sure additions meet strict return criteria. Also, strong lease renewal trends. Most units up for renewal got extended.
Good sign for demand stickiness.
Definitely. And they syndicated 1,700 units in the quarter. Generated strong liquidity and margins from that.
Syndicated. Explain that quickly, like packaging up leases and selling them.
Exactly. Think of it like packaging up a portion of their leased fleet and selling it off to institutional investors. It's smart, generates immediate cash, frees up their own capital so they can reinvest in new assets, and they don't hold all the risk on their own books.
Makes sense. Okay, now new rail cars. The market there and the backlog. What's happening?
They booked orders for 3,900 new units, valued at over $500 million in Q3.
Solid quarter for orders.
Yeah, and their global new railcar backlog is still healthy. Nearly 19,000 units. Gives them industry-leading visibility.
Okay, but you mentioned, I think the notes said, this backlog, while healthy, is actually the lowest since Q2 2014.
That's right.
For the average listener, that might sound contradictory. Lowest in a decade, but still robust. How does that work in this industry?
It's a great question. It really speaks to the cyclical nature of this business. While the number itself is lower than peak years, management emphasized that, within the current industry landscape, it still provides excellent visibility. Enough to manage production lines efficiently.
Okay, context is key.
Exactly. And what's also important, and this adds another layer of revenue, is their programmatic railcar restoration work.
Right. You mentioned that. Not in the backlog numbers.
Not included in backlog or deliveries, no. But it's performing well. Involves a lot of cars, maybe around 3,000 annually, and it's high-margin work.
So like refurbishing old cars.
More than just a quick wash.
Yeah.
Think of it like giving old cars a full spa treatment. It's a valuable business for them, high margin.
Okay. So with all these strengths, efficiency, balance sheet, leasing, backlog, it's not surprising. Management sounds pretty confident.
Yeah, their updated guidance reflects that.
For the rest of fiscal 2025, they're raising aggregate gross margin guidance.
Yep. Raising it to a midpoint of 17.7% to 18.3%. That's up a solid 75 basis points.
Nice bump.
And also raising operating margin percentage. Midpoint now 10.6% to 11%. Up 35 basis points.
And delivery and revenue guidance?
Affirmed. Holding steady there.
Yeah.
They also gave specific investment guidance. Manufacturing, around $145 million. Leasing and fleet management, about $270 million gross investment.
Okay.
With expected proceeds from selling equipment around $75 million. So net investment in leasing is lower, like we discussed.
Right. So this updated guidance, it signals what? Better visibility for Q4, confidence in hitting the numbers?
Pretty much. Deep confidence in their operational execution and ability to capitalize on market conditions, I'd say. Oh, and they flag Q4 interest expense, maybe $25 million, but subject to FX volatility.
Just detail there.
Okay, good details. That leads nicely into the broader investor context. Yep. What are the macro trends, the policy tailwinds maybe, that Greenbrier seems positioned to benefit from? Management talked about USMCA.
Right, the U.S.-Mexico-Canada agreement. The fact that compliant products remain tariff-free is huge for them.
Why specifically? It lets them optimize their North American supply chain, especially with their Mexico operations, without facing punitive costs. It's a big competitive edge compared to companies maybe relying more on overseas production for the North American market. Policy certainty helps.
Okay. What else on the policy front?
Well, the Senate passing the budget bill, including tax policy, that's expected to energize markets for capital goods, like rail cars.
How so? Any specific policies?
Yeah, they anticipate benefits from things like 45Z. That's the renewable fuels bill.
Ah, okay. Renewable fuels. So that drives demand for
Centralized rail cars. Cars to transport ethanol, soybean crush, sustainable aviation fuel feedstocks, all that stuff. 45Z incentivizes production, which means more stuff needs to be moved by rail.
direct link there.
Definitely. And then there's bonus depreciation or expensing.
Right. That old chestnut. Remind us quickly.
Allows companies buying assets, like new rail cars, to deduct a large chunk of the cost immediately instead of spreading it over years. Makes buying new equipment much more attractive financially for Greenbrier's customers because it lowers their taxable income right away.
So these aren't just like obscure tax codes. For Greenbrier, they potentially mean
A more predictable demand stream almost. It de-risks some of their future order book, creates a strong pull from customers wanting to take advantage.
interesting. Another thing that stood out was fleet age, the replacement cycle.
Yeah, that's a big one.
Average age of the North American railcar fleet is over 20 years, highest in a decade.
That's right. And that's a critical driver. Think of it like, an aging car on its last legs. Eventually it has to be replaced or needs major work.
So driving maintenance and replacement demand.
Exactly. And specifically, look at the boxcar fleet. It's seeing significant attrition, maybe 6,000 to 8,000 cars leaving the fleet each year. But replacements are lagging, maybe around 5,000. Partly because new cars have higher cubic capacity, so you need fewer. But still, there's a gap.
Creates pent-up demand.
Absolutely. Pent-up demand for replacement, combined with that overall aging fleet. It bodes really well for future orders for companies like Greenbrier. It's a structural tailwind, not going away soon.
Okay. What about globally? How are things looking in, say, Europe and Brazil? Similar dynamics.
A bit different. Europe activity is kind of muted right now.
Yeah.
Broader economy is sluggish,
Makes sense.
but there are pockets of demand, like rail cars needed for infrastructure investment in Germany. Management sounds confident about the medium and long-term recovery prospects in Europe, though.
And Brazil.
Demand there is modestly increasing. Seems customers are finishing up infrastructure projects and are now shifting back to actually purchasing rail cars.
Okay.
And Brazil might also potentially benefit from some of the U.S. tariff activity reordering global trade routes, could boost freight rail down there, helping Greenbrier's presence.
Interesting ripple effects.
Yeah. Oh, one more point on demand outlook overall. Management did say inquiries have been a bit slow to convert into firm orders lately.
Oh, why is that?
Seems customers are waiting for a bit more clarity on U.S. trade policy, maybe stable commodity prices, before committing big capital. But they also said the sales pipeline itself is strong.
So potential orders are there, just waiting for the trigger.
That's the sense. Management expressed optimism for the medium to long term, expecting a strong finish to their fiscal year and anticipate demand growth as the fleet keeps aging and policy clarifies. And the demand seems broad-based across different car types, not just reliant on one sector.
Okay. So putting it all together, the efficiency, the policy stuff, the aging fleet, Greenbrier's position, it kind of begs the question, how might an investor, purely theoretically, of course, think about this?
Right.
Which brings us to our This Is Not Financial Advices segment. What's an outrageous but plausible trade idea that springs to mind just for entertainment?
Okay, well, keeping in mind this is purely theoretical exploration.
Absolutely. Not advice.
Imagine this. Maybe a long position in Greenbrier, paired with, say, a short position on a basket of older, maybe less diversified industrial or freight companies.
Okay. Companies reliant on
Aging, less efficient supply chains, maybe ones that aren't easily USMCA compliant.
Interesting hedge. What's the rationale?
Well, the idea would be to capitalize on Greenbrier's strong position, benefiting from that aging rail fleet we talked about, the new tax policies like bonus depreciation, boosting capital goods investment, maybe the 45Z renewable fuels demand.
Right, all those tailwinds.
Exactly. And at the same time, you're sort of hedging against broader economic uncertainty by betting against companies that might be less equipped to adapt, less able to handle evolving trade policies or invest in needed infrastructure upgrades.
So it's a play on adaptability. Greenbrier adapting well, others maybe not so much.
Kind of a play on the structural tailwinds for Greenbrier versus potential headwinds for those slower to adapt in this changing environment. Outrageous, but plausible maybe?
Certainly food for thought. A play on forward-thinking strategy versus legacy challenges. Okay, let's wrap things up. Greenbrier's Q3 performance was definitely robust. Strong financials, proactive efficiencies.
And a confident outlook, yeah. Management's strategic execution seems pretty clear. Navigating the volatility, leveraging those tailwinds like policy shifts and the aging fleet.
Absolutely. And just to reiterate, our discussion today, including that trade idea, is purely for informational purposes.
Definitely not financial advice. Always do your own research.
Indeed. As you, the listener, consider the industrial landscape, maybe think about how these broader policy shifts, the constant need for infrastructure upgrades, how they might keep reshaping sectors like railcar manufacturing.
Yeah, there's a lot to watch as these powerful trends continue to play out. Lots to consider.